product that builds the die too soon. It's built on a guaranteed universal chassis. I'll talk about what that means here in a second for those of you that aren't as familiar with the GUL. We build a chronic illness rider, and I'll talk about that, how ours is different from it, that goes into the product. And lastly, the longevity protection. I live too long. People always say to me, Nate, how do I want to live a long life. We all want to live a long life. But nobody wants to live a long life with no assets to live off of. So how can we protect about that? So let's talk first about the life insurance piece during the die too soon. We built this on our Secure Lifetime Guaranteed Universal Life policy. For those of you that don't understand or haven't sold Guaranteed Universal Life in the past, Guaranteed Universal Life is if you pay a premium, you can guarantee a death benefit all the way out to age 90, 95, 100, 105, 121, you choose. In this scenario, under the Asset Protector, we're doing it to age 100, and I'll show you why as it goes through. We have guaranteed premiums, which gives you guaranteed death benefits. No trust me aspect. There's no assumed rate. You pay the premium, you get a death benefit. We have a guaranteed cash value. There's not. There's a couple of our competitors do have this, but it's becoming fewer and fewer. A lot of carriers have actually gone away from GUL altogether. But there's guaranteed cash value built into that policy, which gives you the optionality that if, at a later event, if you have to have cash for emergencies or something, there is some cash in there. 50% RLP at policy year 20. You'll hear the term optionality I mentioned it a second ago. We believe in giving the client as many options as possible in this policy to not just paint them into the corner. The GUL of old, and there was a lot of it sold over the last 15 years, the only option you had is you paid the premium, you got the death benefit. There's no guaranteed cash, there's no RLP. If you paid the premium late, it screwed up your shadow account, et cetera, et cetera. So because of that, we've tried to build a much more client-friendly policy that gives you some options in it, in addition to that death benefit. The main purpose of GUL is still death benefit. But if your needs change, your situation changes, you have some emergencies, it's out there for you. And then 100% ROP at age 85. And we're the only carrier out there that has this option. It's definitely an interesting thing that's out there, and we're doing that through the longevity rider, and I'll explain more of that as it goes on. So let's talk about how the ROP works, just so people understand it. If you take the ROP option, you obviously surrender the policy. But in this scenario, if I've got a client that is paying, buys it at age 56, and this is just the GUL, they're paying $15,000 in premium for 20 years. At the end of that 20 years, they've obviously paid $300,000 and change. If they decide to surrender the policy, they can walk away from that policy with $150,000 and change and go through. So that having that $1 million coverage and the option to go out until their age, whatever we ran it to, was half of that $15,000, $7,500. And you'll notice on the far right that the guaranteed cash is only $35,000 in those early years in the GUL. So as it goes through, obviously it's 4 times the guaranteed cash surrender value that's built in that GUL. If you get into that, if you're into the 17th or 18th year and your client decides, I don't know if I want this, it's definitely worth making those next 2 payments to get it to that $150 to get it out. So with the GUL, like I said, most people understand how they work, but ours is the big differences within our GUL are guaranteed cash, guaranteed cash, ROP in the 20th year of 50%, and the flexibility to choose if you want it to dial a guarantee and dial a pay period. Okay, let's move back on. Getting sick along the way. Chronic illness is as much why you guys are on this call. It's become a much bigger player in today's marketplace. Because truth be told, as the baby boomers get older, they really have 3 options to take care of this. It's the #1 risk to their portfolio. They worked their whole life to build this nest egg, and chronic and long-term care costs are the #1 risk. Their options are, A, do nothing, self-insure, which is obviously not very good when it's the #1 risk to their portfolio. 2, buy a long-term care policy. Long-term care, great product, great go through, but as many of you know that sell it, it's getting a harder sale. It's gotten some bad press with rate changes and everything else. And some clients are not willing to go through it, but it is obviously the best solution when you can, when the client can go through it. The problem with it, and what the clients always come back with, as you all know, is that, what if I don't use it? And so the third option then becomes a leverage product, and that's what the asset protector falls into. You buy a leverage product that will help you leverage using life insurance or something else to do it. So let's talk a little bit about how ours is different that's out there. Our product is called the Accelerated Access Solution, the AAS. It is a 101G product. What does that mean to you? We chose the 101G for a couple of reasons. One, we chose it for that you didn't need to have a long-term care license. There are some FAs and different reps out there that have chosen not to go get their health license depending on their state. That's one option. That's one reason it's good. To qualify for the 101G, you have to have 2 of 6 ADLs, or the severe cognitive impairment, no different than anything else that's out there. And the one drawback really is that on a 101G is it needs to be deemed permanent. AIG/American General did a look at our claims history. Our claims history showed that 82% of all our claims were permanent. And I have reps ask me routinely, Nate, well, what would be something that would not be covered in this? And really, the two that I hear routinely are obviously hip replacement. And as many as you know, once a broken hip happens, it's not. They may get better for a short time, but things quickly go through. And the other one is then the 50 or 60-year-old Harley wreck is the one that always gets brought up in meetings. 60-year-old guy is driving his Harley, he wrecks, he's out for 8 or 10 months. The 101G chronic rider doesn't do it. The one advantage that the chronic does bring it is the indemnity benefit. And we're finding more and more clients and reps are liking the option of having an indemnity benefit, which basically means that if you qualify and you have a percentage of your death benefit that is paid monthly up to the max per diem, which is $9,900 currently, that if you qualify, you get the per diem, you get that $9,900. If it was today, if I went on claim, and I could take that money and do with it whatever I want. You can spend it on anything. You can spend it on qualified care. You can spend it on non-qualified care. You can pay a daughter to come work in your home to take care of you. She can quit her job even though she's not a nurse or not a qualified care physician, and you do it. You just get that $9,900. If you're paying your daughter, $3,000 a month to come take care of you, you have that $6,900 to do whatever you want. And clients like that flexibility. They don't want to have to do receipt reimbursement into it. And then all of a sudden the flexible benefit base. We're one of the few carriers out there that you can choose 100% of the death benefit down to 50% of the death benefit. Where this comes into, there's a lot of people that would like to have $1 million or $2 million worth of life insurance, but they really don't think they need $2 million of chronic care. As we know, $2 million of chronic care at the rates of per diem, $9,900 a month today is a long time. So in those scenarios, a lot of times you'll see people say, well, I'm going to pick a $1.5 million in death benefit, but I only want 50% of it in the chronic. And you'll end up getting $750 in chronic, which is, a great policy, and then go from there. One of the other things that ours is different than some of the things that are out there is, every chronic rider that's out there has a 2% per month option. So basically, for easy math, if I have a $100,000 policy, it's going to pay out $2,000 a month when I go on claim, up to the per diem. It won't go over that. So if you can choose the 2% option. You can choose the 4% option. When you choose the 4% option, obviously the math is the same way. I've got I've got a $100,000 policy. It's going to pay out $4,000 per month until that benefit is expired. And then lastly, and this is what's different than everyone else, although I am hearing rumors and rumblings through the industry that more and more carriers are looking at trying to do this because it's the greatest way to hedge against inflation. We have the per diem option. What the per diem option basically means is what is your total benefit divided by 12 up to the maximum. And you will be paid up to the per diem at time of claim. So think about that for a minute. And we'll use me. I'm actually, as a 44-year-old, I hope that I don't need chronic care for at least 40 more years. And I decide to buy a chronic policy today, and let's say it's, that I'm 40 years out, if the per diem's 9,900 a month right now, what's it going to be? Can anybody tell me what it's going to be in 40 to 42 years? No, nobody knows. Who knows what inflation will be? Who knows what the certain market situations may be? But if I, excuse me, if I buy the per diem option, I have the availability that if I only have a $300,000 policy, and if I would have chosen if I'd have chosen the 4%, per month today, and I went on claim, I'm eligible to get 12 grand per month. But I'm only going to get 9,900 because we're not going to pay more than the per diem. If in 10 years that 4% is, let's say it happens to get to that 12,000, I would get that 12,000 with the 4%. But if I went back 40 years and I only have the 4%, and I'm still only going to get 12, even though the per diem may be 20,000. So if you choose the per diem option on the application, and if in 20 years that per diem is $20,000, I'm going to get $20,000 a month until my benefit is expired or death benefit is expired. So with that, obviously, and people ask me all the time, say, Nate, well, when would I want to do that per diem cap? Lower death benefits and younger ages is really the rule of thumb when you go into that. So the question that always comes in on this, well, Nate, listen, it's great. Now I want to know, how do you guys do this? Obviously, for life insurance, we underwrite for mortality. With chronic care, we obviously underwrite for morbidity also. So there's a supplement to the normal application that we want to ask some questions that's going to do it. And when you do this, how do we choose between the rider? Well, in this supplement, you choose what you want. And one simple thing, I can choose the maximum, the 2%, 4%, or the maximum per diem allowance. And then I also can do what percentage, 50, 60, 70, 80, 90, up to 100% of the death benefit. And there's also some kick-out questions. Just like your long-term care, is if somebody is already can't meet ADLs, they're obviously thrown out. If they've been, nursing home, they want to go through if you've got MS or different things like that. There are kick-out questions that we're not going to be able to do it. But one of the beauties of this with that is there is no waiting period. Meaning, as you go through, if I'm Nate Williams and I buy a policy today, and I have a chronic event in, 6 months, I do have my elimination period, but other than the elimination period, I can start going on claim. A lot of these products have 5-year waiting periods before you can activate it. Those don't exist with that. It's just normal, other than the 90-day elimination, then you go from there. So I've talked about dying too soon, and I've talked about getting sick along the way. So let's say, Nate, you made it to 85. You're still healthy. You haven't died. You haven't got sick. What if you're all of a sudden I'm 85 and I've got to figure out how to get to that 104, or trying to extend my assets? What's going to happen with that? Well, that's living too long. So let's talk a little bit about living too long and what it means in America today. 61% of Americans surveyed are more scared of outliving their retirement income than they are of death. Think about that for a minute. 61%. And obviously, it's a big concern out there. That's why the FA space is so filled with people trying to figure out how to financially plan. I hear it day in, day out as I talk to FAs, how many of their clients are in that 50 to 62, 63 range that are saying, I don't have enough money. How do we, how can we stretch this to go further? And here's another statistic that's fairly staggering. 48% of Americans working age, 45 to 70, have no financial plans in place to protect themselves outside of, and then really through the rising cost of retirement too. I mean, almost half. And that goes back a little bit to the beginning of what the Limerick study of people more concerned about themselves. So one of the things that's happening out there is, here's a statistic that's from the Retire Stronger. A couple retiring today is expected to spend $241,000 on health care costs. Now, this isn't chronic or long-term care costs. Health care costs, $241,000 of their own money outside of Medicare. Now, think about that. How many of your clients are going to fall into that? Is that 240 going to put a dent in what they're trying to do? So what we've come up with, well, before we go into it, let's go into a little bit about what's going to happen to what are some of the things that are out there. Obviously, debt. More and more people are carrying debt into retirement. That was something that very rarely people did 20 or 30 years ago. Historically low interest rates. I had a conversation with my 81-year-old father, a month or two ago, and he said to me, Nate, if you'd have told me in 1978 that there would have been a 5-year period that CD rates would have been below 1%, he goes, I would have bet my whole portfolio that wouldn't have happened. And if anybody can remember back that long, how at that point in 1978 he was getting 16% return on his CDs. 16%. So the historical low interest rates have got everybody by in the history of the U.S. it's never happened. We've had it that low for that long. Stock market corrections, don't need to explain that. Everybody lives through that. Rising income tax rates. As I go around, one of the things I ask is, in a group of reps and sometimes even clients, I'll say, how many people out there, think long-term trend for income tax rates is going up or down? How many people think there's a chance it'll go down? No one ever raises their hands. There may be dips that interest rate, that income tax rates may go down a little bit, but the government in the history of the world, government never gets smaller until it topples. So obviously, income tax rates are going to rise. Social Security uncertainty. A lot of your people in your 40s never thought it was going to be there anyway. I talked about health care expenses. Didn't save enough. That's the biggest issue that's out there right now. As many of us know, midlife hits you very quickly and can happen before you blink. So, and then political uncertainty. So what we've done is we've come up with a rider on this policy called the Lifestyle Income Solution, the LIS. It is a longevity rider. Basically, what you're doing for no other reason than turning the age of 85. By living to 85, you can accelerate up to 10% of your death benefit per year, dollar for dollar. Now think about that for a minute. If any of you are in the FA space, or you know FAs, or you work with FAs, if I came into your office today and said, how much money do I need to retire? The rhetorical question that they always come back with is, well, tell me how long you're going to live, and I'll tell you. If an FA could come in and say, you know what, we're going to expend most of your assets from age 65 to 85. Because if you do live past your life expectancy at 85, we have this retirement backstop called the Lifestyle Income Solution / Longevity Rider from American General on this policy, that we will accelerate your $1 million policy, and you'll get $100,000 per year for 10 years until it comes out. Talked about that. The next question comes in and says, well, Nate, what are the taxation of that? As we know, there's only 2 ways to pull tax. Death benefit can only be distributed 2 ways tax-free: chronic illness or death benefit. So within this scenario, it is tax-free up to basis and then ordinary income afterwards. In most scenarios, that's somewhere between the 36 and 46 month. You start moving over from, for a single person in their 50s, somewhere in between there, you'll start moving it over to that. So let's talk about what does this mean and how does it affect you? So here's a client that bought it at age 55. We fast forward 30 years later, they had a $14,626 premium. They had a $1 million death benefit. Right? As we go through to it, at age 85, they are still alive and they're still healthy, and they say, hey, listen, I'm going to start pulling down my death benefit using this rider. They kick it on. Currently, there's some computing rounding error, so it isn't 10% exactly. You'll notice that it actually pays out almost, not quite 10%, and then have a little rollover. But I start pulling out $99,600 per year. You'll notice on the death benefit side, it drops proportionally dollar for dollar as you go through. So if I take my first withdrawal of $99,600 and then I pass away, my heirs get $900,400, dollar for dollar as it goes through. Guaranteed still out there. All of your premiums, if you looked at it, the cumulative premiums were $438,000. That number almost comes, your premiums get returned literally in 4.5 years. And you still have death benefit that goes through. And if you look at the cash value versus the premium outlaid, you're still going to have 2.5 times more to go through and do it. So as your clients are sitting there saying, well, wait a minute, how am I going to, how am I going to fund retirement? How am I going to, I'm worried about these things. Here's a life insurance policy that allows you to really leverage your dollars for premium, not only for death benefit, but for chronic and also longevity to go through. So let's talk about telling the story as we start wrapping this up. From years 20 to 40 in our working years, we have 3 big risks that we normally sell insurance for. Those 3 risks are kids to college, mortgage replacement, and income replacement, right? So as we go through this and we go through, as I get closer to age 65, when I'm age 62, those risks diminish over time, and it's why we only sell term insurance to 65. Because hopefully at age 65, the kids are done through college, mortgage paid off. If I'm, hopefully, the mortgage is getting paid down or the house is paid off. And also I've got income replacement. I've only got 2 or 3 more years to retirement, so I'm not trying to make up 20 years of working. I just got to, if I die, I've only got to cover 2 or 3 years that I was planning on. What I propose is as we get into retirement, we have greater risks that get bigger as we get older, and we don't do anything currently to insure against those. Financial risks, stock market adjustments, low interest rates. As I talked about, my father lives off the interest of his portfolio, and he never thought he'd have to work. He always assumed he could get 7 or 8% at minimum on his portfolio. Currently, he's getting 5, and he's working really hard to get that through some muni bonds and some other stuff right now. So, he never thought that he'd have this 7-year period that would be so lean on it, and it's caused him to have to, to change plans. Healthcare costs. I talked about this isn't long-term care or chronic care. This is like healthcare costs, the rising cost of healthcare. $241,000 spent on healthcare alone outside of Medicare and chronic. And then reduce Social Security income. A lot of times FAs will say, well, I've got, this couple's planning on they're going to get $3,400 a month with both of them, and they plan that out, and that's how they're going to live their life. Well, one of the things that's interesting is, well, what if one of the spouse dies at age 67? And that $1,400 a month you were planning to get for the next 30 years, until she was 90 or whatever the age may be, isn't there anymore. They're about hundreds of thousands of dollars. And, and they talk about those fixed incomes. Well, if we can live on $4,000 a month, okay, great. What do you do when your furnace, your furnace breaks down and you need to write a $25,000 check, or your house needs a new roof, or you need a new car? How are you going to do that? Those risks get bigger over time. And how do we insure against all of those risks that are out there? Well, with the asset protector, we're going to have a death benefit if we die too soon of $1 million. If we get sick along the way, we're going to get $118,000 annually for up to 8.4 years as chronic. And if I live to the age 85 and I haven't done it, I get close to $100,000 a year for 10 years as a longevity rider. Die too soon, get sick along the way, live too long. All of those things are covered in it. And it's one thing that I want to stress to you as we start to get this wrapped up is this is 100% guaranteed. A real world scenario on this is I buy $1 million policy and I'm 50 years old, I pay my premiums. When I turn age 85, at age 85 I kick on my longevity, I kick on the LIS because I'm still healthy, and I pull out $100,000 the first year. And the second year I'm healthy, I pull out another $100,000. If I died today, my heirs would get 800 grand. I've taken out 2. But then let's pretend that, you know, somewhere in the 87th year in a real world scenario, I have a chronic event. I start getting Alzheimer's. Something, I have a stroke at 87. At 87, I go on chronic, and let's do it for easy math, and all of a sudden now I can accelerate $200,000 a year. So in the third year, I pull $200,000 of chronic out. I haven't paid any taxes on anything. The first 2 years were tax-free. Now that I'm on a chronic, it's tax-free. So I take and I live for 2 years. So I take out another $200,000 and $200,000 in chronic. I've pulled out $600,000 of my life insurance policy and used it while I was alive. At the end of the 4th year, I pass away. My heirs will get 400 grand tax-free, assuming it was set up right, and it's not fine. So not that many things. There's nothing out there that can guarantee that has this flexibility and this setup that is guaranteed dollar for dollar. No trust me aspect, no settlement option, etc. So when you do it, you know what I say to this is a lot of these sales are actually term sales that are upsold. You know, normally they would just go sell a term sale to a 50. We're selling more and more term to 50-year-olds because that's what they're used to buying. Turn it into permanent sales. And do it by selling the value, right? You sell it by, hey, listen, you know, yes, I can buy you term insurance, but as you know, as the risks are shown, and you can learn how and you can, you know, learn the story behind it. One of these things are going to happen, and I wouldn't be doing my job if I didn't protect all 3 of these aspects as you go through. Die too soon, become seriously ill, or outlive retirement assets. In closing, I want to make sure that you visit retirestronger.com. That's www.retirestronger.com. It has everything that you need. On the top right-hand corner of it is a producer section. There's a quick 6-minute video that shows telling the story. It's got our Director of Agent Productivity, Joe Ross, on there, and there's some other valuable, even non-product, non-carrier sales ideas to help you do it. So as you go through, and the last thing I will give you is one of the reps that I have a P&C rep that's been very successful in making this change. He made the commitment that he was going to always open his mouth about life insurance. He was going to do it with the Asset Protector story. And how he did it was he said, listen, he was concerned he was going to mess up his other business, but what he did is he made the commitment that he was going to use the Columbo approach. And at the end of their clients meeting, he would say, you know, great, I appreciate your business. Oh, by the way, I also sell life insurance. Do you have the new kind of insurance or the old kind of insurance? And they'd always stop and say, oh, I don't know what I have. And he said, well, you have, you know, he's like, well, what's the new kind of insurance? Because the new kind of insurance is life insurance you can use while you're alive. And that opened the discussion on selling the value. So with no further, Dave, I'll turn it back to you.
Hey, thank you, Nate. Very good job. Very informative. Great, awesome product, and the timing of this product is just perfect. I have gone through and unmuted everybody who has enabled their audio control. So if anybody has any questions of Nate, now would be the time to bring them up.
What was that web address again?
It's www.retirestronger.com.
Thank you.
Any other questions for Nate this morning? Okay, if there are no additional questions, I want to thank everybody again for taking the time this morning to join Nate and myself. We did record this session, so you can go back and view it along with other recorded webinars on our website, which is whyAIM.com, WHYAIM.com. Stay tuned to that website as well for future topics of additional webinars we have coming up. And again, Nate, thank you again for taking your valuable time to join us and lead us down the path and get us more educated on your offering. We think the timing, is, like I mentioned earlier, is just perfect. So with that, everybody have a great weekend, and thanks again for joining me. Bye.
Thank you, everyone.